Welcome to CSHE's Certified Healthcare Facility Manager Study Guide. In this section of the study guide, we will be reviewing the finance portion of the test. These topics are taken directly from the CHFM Candidate Handbook. Approximately 14 of the 100 questions on the exam will be on the area of finance, with 3 of these being the ability to recall or recognize specific information regarding finance, and 3 questions being the ability to comprehend, relate, or apply knowledge to new or changing situations regarding finance. 8 questions being the ability to analyze and synthesize information, determine solutions, and/or evaluate the usefulness of a solution in regards to finance. You will need to understand the following definitions. Assets. These are the entries on a balance sheet showing all properties, both tangible and intangible, and claims against others that may be applied to cover the liabilities of a person or business. Assets can include cash, stock, inventories, property rights, and goodwill. Next is liability. It is a financial obligation, debt, claim, or potential loss. Next is income. This is the amount of money or its equivalent received during a period of time in exchange for labor or services from the sale of goods or property, or as profit from financial investments. Next is cost. It is an amount paid or required in payment for a purchase. Expense. It is an expenditure of money or a cost. Debits are an item of debt as recorded in an account. Next is credit. This is the deduction of a payment made by a debtor from an amount due. Next is net income, which is the excess of revenues over outlays in a given period of time. Balance sheet. It is a statement of a business or institution that lists the assets, debts, and owner's investment as of a specified date. Income statement is a financial statement that gives operating results for a specific period. Next is depreciation, which is an allowance made for a loss in value of property. You will also need to know the 3 types of depreciation, which are declining balance, straight line, and sum of the year's digits. You will also need to know the 3 inventory methods, which are average cost, LIFO, which is last in and first out, or FIFO, which is first in and first out. Taken directly from the CHFM handbook, the first area we will be covering is on engaging in system-wide contracting management and administration. Body shop contracting is a type of outsourcing in which the contractor supplies personnel who possess the needed skills and abilities along with frontline supervision, and the facility manager provides organization, direction, and evaluation. In this situation, the facility manager sets policy, develops requirements, and provides oversight of the work performed by the contracted personnel. Consultants may be able to suggest policy and requirements, but suggestions are subject to the approval of the in-house management. The body shop arrangement provides flexibility through the use of a mix of contracted personnel and in-house staff. A management contract is used when an organization outsources the management of its facility. The contract creates an agency relationship between the organization and the maintenance and operations contractor. The specific rights and responsibilities of both parties should be stated clearly in the contract. Some examples include detailing the duties of the contractor and specifying the methods and frequencies of the work. You should always contain some type of confidentiality agreement. You should also contain a statement that all the work is to be done in compliance with the laws at the local, state, and federal levels. It also must be reviewed by the hospital's legal counsel. An indefinite quantity contract allows the facility manager to order services or supplies within a fixed dollar amount, but does not limit the deal to a specific contractor. It is most often used for repair work to things such as walls, ceilings, flooring, carpet, glass, concrete, appliance repair and replacement, painting, and pruning and removal of trees. When the facility manager determines the need for one of the services or supplies listed on the screen, he or she writes a delivery order against the contract, and the accounting department obligates the funds. The major use for a job order contract is for work that exceeds a price that has been specified beforehand. The job order contract features a price book, which lists prices for specific tasks that have been previously established and agreed upon. When work is to be done under the contract, the number of work units and the price are established by the contractor and the facility manager or contracts coordinator. Then purchasing places an order for the work. Job order contracts are advantageous to the medical facility because they allow for a quick response to a need. Next, we will review negotiating and finalizing contracts. You will need to know the following contract terms and their definitions. The first is cost plus percentage of costs. Here, the buyer assumes risks, provides for reimbursement to the contractor for allowable costs due to contract performance. Additionally, the contractor receives an agreed-upon percentage of the estimated costs as a profit. Although prohibited in federal government, this form of contracting is used in private and particularly the construction industry. Next is cost plus fixed fee. It has a high risk to the buyer and only moderate risk to the seller. It provides that the seller be reimbursed for allowable costs for performing the contract. And in addition, the seller receives a profit and fixed fee payments, usually based on a percentage of estimated costs. Next is cost plus incentive fee. Here, the seller is paid for allowable performance costs along with a predetermined fee and an incentive bonus, usually used with long performance periods with hardware and development test requirements. Next is the fixed price incentive fee. This is the most complex type of contract, which is composed of a target cost, target profit, target price, ceiling price, and share ratio, usually used when contracts are for substantial sums and involve a long production time. This enables the seller to develop production efficiency during the performance of the contract. Next is firm fixed price. It is an agreement where the contractor agrees to furnish supplies or services at a specified price that is not subject to adjustment because of performance costs. It is best suited when reasonably definite production specifications are available and costs are relatively certain. And the final is time and materials. This is a hybrid type of contractual arrangement that contains aspects of both cost reimbursable and fixed price type arrangements. Based upon performing a prescribed amount of work previously agreed upon by both the seller and buyer, where the seller is paid for amount of time it takes to accomplish the work. The seller also provides but is reimbursed for the materials to complete the work. The next section we will be covering is calculating payback, potential of possible improvements in existing systems. The payback period is a method of calculating how long it will take a project to pay back the capital investment required for it. The calculation may be used to determine if a project is acceptable or to decide which project is the most acceptable. The payback period is calculated by dividing the cost of the project by the annual net cash flow the project is expected to bring in. if the number of years determined by the calculation is equal to or less than a predetermined figure, the project is acceptable. When calculations are made for the purpose of choosing between two or more projects, the choice would be the one with the shortest payback period. Looking at the advantages of the payback period evaluation method, a few are that it is simple to calculate, it is easy to understand, it is simple to use, and this is the most popular method of evaluating a capital investment. Both the average payback period method and the actual payback period method provide a measure of risk. The disadvantages to both methods include it is simplistic and do not give full consideration to the timing of the cash inflow during the payback period. It also does not consider the continued inflow of cash after the payback period. And because of these drawbacks, other evaluation techniques should also be used in the decision-making process. The average and actual payback period calculations help the facility manager make a decision about the acceptability of a proposed project. The average payback period is calculated by dividing the net investment of the project by the expected average annual cash inflow. The actual payback period is a similar calculation that divides the initial investment by the net cash income. The net cash income is the after-tax amount of the savings from the project, plus the depreciation expense tax write-off. The actual payback period considers the timing of cash flows, whereas the average payback period does not. Next, we're going to look at performing lifecycle cost analysis. Lifecycle costing is a method of determining the acceptability of a project or of deciding between projects by calculating the cost of the project throughout its life. The calculation must include the initial investment, the cost of operation and maintenance, administrative expenses, finance charges, the consumption of energy, and the expected modifications and replacements. Also, the CHFM must also consider the final retirement or disposal of the project. In terms of a building, lifecycle costing can be expressed as the funds required to build it, operate it, and dispose of it. Next, we're going to look at managing budgets for the following: operations and maintenance, construction projects, capital, and utilities. First, the operating budget for a facility is a summary of all projected income and expenses for a specific time period. Operating budgets are often constructed on a monthly basis and include projections for the year. Seasonal expenses, such as lawn mowing and snow removal, must be included. Fluctuations in such items as payroll, administrative expenses, prices for material and supplies, taxes, insurance, and general costs must be forecasted as accurately as possible. The budget should be reviewed monthly by the facility manager and accounting, and at least quarterly by a member of upper management. Discrepancies between the budgeted amount of a line item and the actual cost should be investigated and revisions made as necessary. The maintenance and repair budget is part of the operating budget. It covers both routine and preventive maintenance and the custodial care of the facility. The budget must provide cost estimates for both materials and labor needed for those tasks shown on the screen. Major construction projects are part of the capital budget. Since many capital projects are multi-year projects, the estimated figures for materials, labor, and other line items may change as details of the project are worked out. It is difficult to project costs for employee downtime and supervision unless constant input from the project foreman and the project manager occurs. The budget must include projected costs for construction, purchase of furnishings, installation, and the warehousing of materials and tools. The most accurate way for the CHFM to prepare the budget is to break out work items and sub-items and list the projected costs for each one. The capital budget is not discrete for a single year, since construction and renovation may be multi-year projects. Tax laws and company policy control which items can be capitalized. Company policy may establish that single purchases costing less than a predetermined amount may not be capitalized. Some capital projects may reduce costs of one type while increasing others, such as the replacement of a lease building with one owned by the company. Reflect the findings of your needs analysis for construction and replacement, which is part of your strategic plan, in the capital budget. The utilities budget is part of the operational budget and contains estimated costs for electricity, water, and fuels such as natural gas and diesel. Planned energy savings may also be indicated. The facility manager must justify directed purchases, since utilities are often secured from a local, sole source supplier. Base estimated costs for the various utilities on your facility's historical usage. Note that utility companies can usually help with these figures, since many have software that can produce sophisticated analysis and accurate forecasts that take into consideration factors such as rate increases and abnormal weather patterns. Next, we are going to review developing capital and operating expense budgets. The budget for the facility management department is often the second largest for the organization behind salaries and benefits. It also has unique characteristics that require the CHFM to give explanations and justifications to the finance department. The diversity of the facility management budget creates questions because it encompasses widely different areas, including space planning, waste management, security, housekeeping, mail distribution, utilities, and even others. Government regulations strongly impact the facility management budget, since it is often difficult to determine the cost of compliance. Allow leeway in the facility management budget for reaction to natural disasters and emergencies. Chargebacks are a cost control system in which the cost of facility services requested by a department is charged to that department. Chargebacks may be limited to work that exceeds a set standard. One advantage of the chargeback system is that it encourages awareness of costs, which may lead to lowered operating costs. Department managers may object that 1, the facility manager sets arbitrary rates, 2, that the costs are difficult to calculate and justify, and that 3, the chargebacks create conflict with line managers. The facility manager may complain that a chargeback system means a lack of any discretionary budget. It is usually best for the organization to fund basic needs and charge departments back for extraordinary usage. Next, we are going to look at monitoring energy purchases. Energy consumption records for your healthcare facility must be verified before you authorize accounts payable to pay the utility bills. Energy consumption meters are read at least once a month, and depending on the utility and the organization, they may be read as often as daily. Regardless of how a utility company obtains its billing information, keep careful logs of a facility's consumption for comparison. Compare current records with logs from previous years or with benchmarks to reveal whether or not energy conservation efforts are successful. Energy consumption logs can be used by the Energy Committee to develop energy reduction goals for the facility. Energy reduction goals must be both realistic and practical for each department in your facility. Departments that have low energy requirements may be unable to reduce their consumption much further. Energy committee members should base their goals on reducing energy consumption by a percentage of current usage, rather than on the total cost of energy. Zealous consumption reduction should not interfere with patient care and the quality of test results. A load cycling system is a type of energy management control. The load cycling system staggers operation of large energy-using devices so they do not all operate concurrently. The load cycling system can also be programmed to allow only selected devices to operate during specific time periods. Limiting when and for how long a particular device is in operation controls its energy consumption. One example of load cycling is operating a room's air conditioning unit only when the room is in use. While the air conditioner is operating, shut off another device which is not vital at that time. An electric demand controller is an energy consumption control that is similar to a load cycling system in that it works with a preset energy requirement. The electric demand controller allows several electromechanical devices to operate concurrently until the energy use reaches a preset level. When the preset point is reached, one of the operating devices must be shut off before any additional device can start operating. Electric demand programs are an available part of most computer control systems. Electric demand programs can be very complex and require a large amount of input from management. Next, we're going to be looking at negotiating service agreements. Some specific elements that should be included in service contracts include: they should be written and not verbal. They must identify all parties to the agreement. They should clearly state the service to be performed. They should specify where the service is to be performed and the frequency of performance. They should list the service standards to be met. They should specify exactly how performance will be measured and the consequences of non-performance or poor performance. They should include the date when the contract takes effect and its expiration. They should also state whether subcontractors may be used. They should identify costs according to time period, such as hourly or weekly. They should cover any special provisions, including security, confidentiality, insurance, how emergencies will be handled, and if overtime will be permitted. They should outline circumstances under which the contract can be terminated, and all parties to the contract must sign it. Ask your facility legal counsel to vet the language of your draft before presenting the contract to your service provider. Next, we're going to be looking at evaluating bids for equipment and services. When evaluating bids, involve your facility staff and the procurement department in the bid process. Criteria often used to select a bid for goods or services are: 1, the lowest responsive bid, which may be used for reorders, name brand items, and other routine situations. Second is the lowest evaluated bid can be selected from a group of vendors who have been rated and meet a minimum technical score. And third, before a selection is made according to the highest evaluated bid, the vendors are rated and those scoring below a preset level are eliminated. Those remaining are reevaluated and the contract is awarded to the contractor judged best all around. Next is developing bid documents for equipment and services. The questions shown on the screen should be included as part of a questionnaire sent to bidders. In addition, a facility should not be left vulnerable to risk. Insist that the bidder supply the following additional information in their bids: such as resumes for key personnel proposed for the project, information on completed projects similar to the one now proposed, current contracts for building supplies, customer references, financial references, and proof of bonding and insurance coverage. Next, we're going to be going over documenting energy conservation results to substantiate anticipated savings and payback. EMCS is for promoting, facilitating, and documenting energy conservation. EMS conserves energy by adjusting operating hours and/or recycling equipment. The types of EMS systems include time of day scheduling. This is a type of system which uses electromechanical time clocks to control various functions according to time schedules. Ideally, these systems take into account holidays, weekends, daylight savings time, planned maintenance, and have an override feature. They usually control interior and exterior lighting, security lighting, space heating systems, air conditioning, ventilation and exhaust fans, and also thermostat setbacks and set forwards. The next is temperature and time optimizations. These systems provide for the control of multiple functions and more sophisticated control of temperature, setback, and set forwards. Inside and outside air temperature are monitored and used accordingly to vary the time of startup or setback of heating and/or air conditioning. These systems achieve additional savings by using the least amount of energy to produce comfortable conditions during occupancy. Depending on the complexity of the system, an economizer cycle can also be incorporated. By controlling air dampers, this cycle brings outside air into the cooling system whenever possible. The third and final is demand control systems. With these systems, all of the functions of temperature time optimization and time clock controls are incorporated in a system that also controls electricity demand by cycling pre-selected loads on and off as demand approaches preset limits. Typical interruptible loads are heating, ventilation, and air conditioning systems, air compressor motors, and manufacturing processes that can readily be interrupted or delayed. In addition to generating energy savings by shutting off unnecessary loads, these systems reduce monthly peak demand charges on electric bills. Demand control systems provide for a large number of control and monitoring points. They also incorporate features such as the ability to monitor fire and burglar alarms, log internal environmental conditions, record equipment running time and duty cycles, and track energy use. Next, we will be going over some various study questions. Note that some of the questions may seem dated, but many of the topics are still covered in the CHFM exam, so individuals should familiarize themselves with the subjects. Demand-side management, or DSM, programs are developed and offered to organizations by energy providers to do which of the following during peak service? Is it A, monitor the demand for energy supplied by the utility? B, provide emergency energy demand sources? C, reduce energy demand on the utility provider? Or D, improve the quality of the energy provided? C is the best answer here. DSM is an agreement between a facility and a utility guaranteeing the facility will reduce its energy utilization when called upon by the utility provider. For this, the facility receives a discounted electrical rate. Answer A is not correct because monitoring of energy is often a component of DSM, but is only a tool used to determine the progress of the program. Answer B is incorrect because providing emergency energy is not a function of DSM. And answer D is not correct because DSM programs are related to volume rather than quality. Again, answer C is the best answer here. Which of the following contracts requires a schedules of values when negotiating? A, vehicle purchase, B, equipment agreement, C, lump sum bid, or D, guaranteed maximum price? Answer D is the best answer here. A detailed schedule of values is typically included with GMP agreements. Answer A is not the best answer because although a facility manager would want a vehicle purchase to list both standard items included in the list price as well as priced options, this is typically not called a schedule of values. Answer B is not correct because service agreements may have a schedule or pricing breakdown, but this is typically not called a schedule of values. And answer C is not correct because although a facility manager may request a schedule of values on a lump sum contract, it is not typically done. Service agreements on clinical equipment can best be reduced in cost by A, having the facility technician responsible for first response, B, adding equipment to the service agreement, C, using multiple vendors, or D, updating the equipment to the most recent version. Answer C is the best answer here. Service agreements typically give reductions to service agreement costs if personnel at the facility take first response to verify the problem cannot be handled locally. Answer B is not the best answer because although adding equipment to the agreement may lower unit cost on each piece of equipment, it will not reduce the overall cost of the service agreement. Answer C is not the best answer because although multiple vendors may have some impact on price, the price impact will be minimal. And answer D is not the best answer because although newer or updated equipment costs less to maintain, the upfront costs make this prohibitive. Again, answer A is the best answer here. A rooftop air handling unit costs $6,000 per year in utilities to operate and has a monthly service contract for maintenance of $600. A replacement unit will cost $25,000 installed and will use 40% less energy with a service contract of $150 per month. Which of the following is the total payback in years for the replacement unit? 3.2, 4.6, 8.8, or 10.4? Answer A is the best answer here. Annual savings in energy is $2,400 per year, or $6,000 times 40%. Annual savings from the service contract is $5,400 per year, or $450 times 12 months. Take the $2,400 and add it to the $5,400 and equals $7,800 of total savings per year. This value is divided into the purchase price to calculate the total payback in years, equal to 3.2. So answer A is the correct answer here. Which of the following should be used when evaluating and documenting energy conservation results? 1, the degree of days. 2, efficiency of equipment. 3, fuel consumption. Or 4, square footage changes. And they are looking for 3 out of the 4 answers. Number 1 is true because degree days provide more opportunity for trending information from year to year. Number 2 is false. Efficiency of equipment needs to be taken into consideration prior to program development and tracking, but once installed, the information does not vary. Answer 3 is true because fuel consumption is a valid measurement. Answer 4 is true because any square footage changes need to be documented for adequate comparison. Therefore, answer C is the correct response. A facility's current motor service budget is straight-lined at $1,000 per month. By the 5th month, $7,000 of the current year's budget has been spent. The supervisor has stated budgets can have no more than 10% increase. Which of the following will be the maximum motor service budget for the next year? Is it A, $7,700, B, $13,200, C, $14,000, or D, $15,400? Answer B is the correct answer here. Answer B represents this year's budget of $12,000 and a 10% increase for next year, for a total of $13,200. Which of the following major factors should be considered in evaluating life cycle costs? 1, life expectancy, 2, operating costs, 3, purchase price, and 4, equipment capacity. And they are looking for 3 of the 4 answers. Number 1 is true. Life expectancy is determined by the number of years of expected use. Number 2 is true. Operating costs are determined by the cost to operate over the life of use. Number 3 is true because purchase price is determined by replacement cost. Therefore, number 4 is false because equipment capacity is not relative to life cycle costs, meaning that answer A is the correct answer. A facility manager intends to purchase a medical air compressor costing $2,600. The manufacturer has stated the energy-efficient motor will save 10% on electric usage, and that history indicates it will cost $300 in repairs each year. The total capital dollar amount is $2,340, $2,600, $2,640, or $2,900. Answer B is the correct answer because savings and maintenance costs should not be part of the capital purchase price. So answer B is the best answer here. A capital project is being planned with the following information shown on the screen. What amount should be placed in the capital budget for this project? A, $250,000, B, $285,000, C, $310,000, or D, $350,000. Answer C is the best answer here. Architectural and engineering fees, demolition, construction, and furnishings and equipment would all be included in a typical capital project estimate. In this case, the total cost of $310,000, or answer number C. A facility manager is replacing electrical and gas-driven chillers. The electrical chiller costs $295,000 and has a 10% energy rebate. The gas unit costs $425,000 and has a 30% energy rebate. The gas unit is 5% more efficient than the electrical to operate. What capital dollar amount would need to be budgeted to purchase 2 electrical chillers and 1 gas unit? Is it A, B, C, or D, as shown on the screen? Answer D is the best answer here. 2 electrical chillers cost $295,000 each, for a total of $590,000. 1 gas unit costs $425,000. The total of the 3 units is therefore $1,015,000. The rebates do not apply as they are for energy costs, not purchase costs. So D is the correct answer here. A facility manager is drafting an agreement for an energy conservation project with a guaranteed payback period. Which of the following is the best contract to use? Is it A, fee for service, B, lump sum, C, maintenance, or D, performance? Answer D is the correct answer here. A performance contract allows for a service to be performed with guaranteed outcomes. Answer A is incorrect because a fee-for-service contract provides payment for services performed with no guaranteed savings. Answer B is incorrect because a lump sum contract guarantees a maximum price for specific services performed with no guaranteed savings. And answer C is incorrect because a maintenance contract is a contract that services a specific piece of equipment for a specific period of time with no guaranteed savings. Which of the following distinguishes a capital purchase from an operational expense? A, cost and life expectancy. B, fixed versus movable. C, fully funded depreciation. Or D, non-emergent replacement. Answer A is the best answer here. Although the policy may vary from institution to institution, cost and life expectancy are generally used as guidelines for capital purchases. Answer B is not correct because fixed or movable equipment can be purchased through capital protocol or operations. C is not correct because depreciation is not necessarily a factor in capital or operational purchases. Answer D is not correct because unplanned or emergent replacements are not criteria for capital or operational purchases. The best method for quickly providing a budget estimate for a proposed project prior to schematic design is to use A, previous project costs, B, a hard bid from a contractor, C, the capital project budget, D, the dollar per square foot based on construction type. Answer D is the best answer here. It is typical to use a cost per square foot estimate based upon the type of construction being accomplished. Answer A is not the best answer because previous project costs would not provide an estimate for a future project unless it were broken down to cost per square feet and then calculated for the square footage of the future project. Answer B is not the best answer here because there is not enough information prior to the schematic design phase to receive a hard bid from a contractor. And C is not the best answer because the capital project budget does not relate to the project cost. When is an indefinite quantity contract most often used? Is it A, when the contractor uses a job book while bidding on work? Is it B, when in-house staff and contractors are being used and flexibility is needed? Or C, when repair work on flooring, walls, and ceilings of a facility is being done? Or D, when a facility outsources its management? Answer C is the correct answer here. An indefinite quantity contract allows the facility manager to order supplies and services for repair work to floors, ceilings, and wall areas. A job book contract is for work that exceeds a price already established. Mixing in-house personnel and outside contractors provides flexibility and is known as body shop contracting. A management contract is used when a healthcare facility is managed by a third party. So answer C is the best answer here. What is an advantage of the chargeback cost control system? Is it A, it encourages cooperation between different departments? B, it allows a healthcare facility to develop energy reduction goals? C, it allows the facility manager to set rates as he or she wishes? Or D, it encourages department managers to be more aware of costs? Answer D is the best answer here. Chargebacks make managers more aware of costs and can lead to overall cost reductions for a facility. Chargebacks do not encourage cooperation between departments. They sometimes cause conflict. Allowing the facility manager to set rates is not an advantage of the chargeback cost control system. Which of the following is not a component of the life cycle costing method? A, the cost of the project divided by the cash flow. B, the amount of energy consumed during the project. C, the expected modifications and replacements. D, the initial investment in the project. Answer A is the correct answer here. Dividing the cost of a project by the net annual cash flow is done to calculate the payback period. the length of time it will take to recoup the capital investment for a project. Energy consumption is a component and is used to calculate the project's cost through its life. Expected modifications and the initial investment are also used to calculate the life cycle cost, as is the disposal of the project. So answer A is the best answer here. Which of the following should be included in a service contract? Is it A, the year the company was established, B, the consequence of poor performance, C, a verification of energy consumption needs, or D, janitorial services for the entire facility? Answer B is the correct answer here. A service contract should clearly state the consequences of poor or non-performance by the contractor. The year the company was established would be included on a bidder qualification questionnaire. Verifying energy consumption is a duty of the chief engineer, and janitorial services are included in the maintenance and repair budget. So answer B is the best answer. How does the CHFM calculate the average payback potential of a project? A, by adding costs into a fund for basic expenditures and charging departments for overruns. B, by dividing the cost of the project by the annual net cash flow the project is expected to bring in. C, by calculating the sum of the after-tax savings from the project and the depreciation expense. Or D, by delegating work that exceeds the specified price to allow for a quick response to a need. Answer B is the best answer here. The average payback potential is calculated by dividing the cost of the project by the annual net cash flow the project is expected to bring in. If the number of years calculated is equal to or less than a predetermined time period, the project is acceptable. Adding costs into a fund for basic expenditures and charging departments for overruns refers to chargebacks. Calculating the sum of the after-tax savings from the project and the depreciation expense is done to determine the actual payback potential. And delegating work that exceeds the specified price is done using a job order contract. Which of the following practices is used when selecting a bid for goods and services? A, outlining circumstances under which the contract can be terminated. B, selecting from a group of vendors who feature only brand name items. C, eliminating those vendors who score below a preset level. Or D, showing the contract to the facility's legal counsel. Answer C is the correct answer here. Before the highest rated bid is selected, vendors are rated, and those who scored below a preset level are disqualified. The contract is then awarded to the company judged to be the best. Both answers A and D refer to service contract elements. Selecting from a group of vendors who feature only brand name items is a criterion for the lowest responsive bid. So answer C is the best answer here. Which of the following would be included in an operating budget? A, custodial functions, B, compliance costs, C, water consumption, or D, seasonal expenses? Answer D is the correct answer here. Operating budgets include payroll, administrative expenses, supplies, taxes, insurance, and seasonal expenses such as lawn care. Custodial functions such as trash removal are included in a maintenance and repair budget. The cost of compliance with government regulations is in a management budget, and water consumption is part of the utilities budget. Create an annual budget using the expenditures of the last 5 months totaling $850,000. Is it A, $550,000, B, $2,040,000, C, $355,000, or D, $170,000? Answer B is the correct answer here. $850,000 is divided by the 5 months provided to get a monthly budget amount, and then is multiplied by 12 to get an annual budget figure. So answer B is the correct answer. If the facility has used in the first 4 months of the year $800,000 of the $1.6 million annual budget, what is the average monthly budget for the remainder of the year? Is it A, $200,000, B, $100,000, C, $400,000, D, $240,000? Answer B is the correct answer here. $800,000 is subtracted from the annual budget of $1.6 million to get a remaining amount of $800,000. That total is then divided by the remaining number of months in the year, or 8 months, to get a total of $100,000 as the average monthly budget for the remainder of the year. So B is the correct answer. Which of the following is considered an operational expense? A, replacement of a roof. B, replacement of an air handler. C, replacement of generator hose. D, replacement of a dehumidifier. Answer C is the best answer here because answers A, B, and D are all considered capital purchases. This completes the finance portion of the CSHE CHFM study guide.